One of the videos I wanted to work for chapter 15 is the check yourself problem 15-2. It has an answer and they do a great job. I just work mine a little differently and I'd like to show it to you. I don't know if it's any better or any worse. It's just different, and that difference may be helpful in learning the material, or it may be also helpful in trying some different way of learning this. Anyway, so here we go. I know you probably already read this, but let's look at it together anyway. So the master budget called for a volume of 30,000 units. Budgeted direct materials were $4 a unit. So that's the standard cost or the standard price. And that's the standard quantity, 30,000 units. Scott actually produced and sold 32,000 units. That's the actual quantity. And it actually cost $3.90 a unit, $3.90 a unit, not $4. It was a little less. So the actual cost was $3.90, a little less. It says determine the volume variance and materials cost for the materials cost, and then also look at the flexible budget variance for materials cost. So volume and flexible budget variance right there. I'm going to work mine a little differently, and I'm just going to have a little bit different names too. So let's call, all right, play nice. There you go. So standard price. Let's use that, and then we're going to multiply that times the standard quantity. And on this next section, it's going to be 3 sections. On this middle section, we're going to multiply it times standard price, and now we're going to have actual quantity. And then over here, we're going to have actual price times actual quantity. And this is my abbreviations. Before I move on, let's look at what I've done. This side over here is all standard. Standard price times standard quantity and standard price again. And on this side, we have actual. Actual quantity, actual price, and actual quantity again. Here we got planned, actual. It's the same. But I like the way I wrote mine out better this way. I think it looks better. But that's me. All right, and I had a little bit different terminology. So, all right. And what we're going to end up with, we can calculate my computer glitched. Okay, so what we can end up doing is calculating not the 2 variances that are in this example, this check yourself problem, but 3. All right, now most people think, right here, this last thing I drew, most people think of the budget variance as that. All right, we're going to look at that last, and that'll be how we recap. But this is the volume variance, and we're looking at direct materials, so it's direct materials volume variance. And then this is the direct materials price variance. And I just normally just call this variance. This is just the total variance, direct materials variance. Because you're looking at the budget and what happened, what we actually did. All right, so let's start filling in the numbers. And I trust you've recalled the numbers, so I'm just not going to go back up to the last part of the video, scroll up in the Word document and look at it. I'm not going to do that. So the standard price was $4. And again, you can pause the video, look at it if you want. And the standard quantity was 30,000 units. Well, that's obviously 120,000, right? 4 times 30,000. Well, standard price again is $4. Standard price is $4, and the actual quantity was really 32,000. And that's 128,000, I believe. I'm writing faster than the keyboard wants me to go, and it's fussing at me. Or the screen. Here we go. All right. Now the actual price was $390, and the actual quantity was 32,000. And that equals, I've already done the math and I didn't memorize that one, 124.8. Now we are ready to calculate the variances. So 120,000, the difference 120,000, 128,000 is $8,000. So the question is it unfavorable U or favorable F? And it's unfavorable. Okay, it's unfavorable. We're supposed to be able to make production on 30,000 units. Instead, it took us 32,000. So it's unfavorable. And the difference for the price variance is favorable, right? It was $390. That's what we actually paid for it. We budgeted $490. So we're 10 cents better, right? So 10 cents times 32,000 is 3,200, or 128,000 minus 124.8 will also give you 3,200. And it's favorable, right? It's cheaper, 10 cents. All right, so the direct materials variance, 120, 124.8. The difference is 4,800. And is that favorable or unfavorable? Well, we budgeted 120, but it cost 124.8, so it's unfavorable. Let me show you another way to have calculated the 4,800. The 8,000 unfavorable volume variance plus 3,200 favorable price variance. Well, one's unfavorable, the other one's favorable, so you calculate a difference between the two, and you get 4,800. And how do you know when you're just looking at these two if it's unfavorable or favorable? The larger number is unfavorable, so this will also be unfavorable. All right, so if we had just calculated only the 4,800, we would say, oh man, we didn't make goal, $4,800. Why didn't we make goal? Somebody might say, I don't understand. We're paying less than we budgeted. Well, the reason we didn't make goal is because it took more units. It could be management, the assembly line management, could have been purchasing materials that were of poor quality. Some reason caused our efficiency. This is also an efficiency variance. You can consider it an efficiency variance. Is also not going well here. It would be better if it was less, right? We were somehow able to produce the same output with less input. In this case, it was the opposite. To produce the required output, we needed more input. So again, we could have bought bad materials, had to scrap some. Machines aren't calibrated right. Labor workers aren't trained well, and they're not very productive. I don't know, or not producing quality work is what I should have said, not productive. Quality work. Whatever the reason, this really explains more than just saying 4,800. All right, so now we know that the price was good, but even though the price was good, it didn't overcome this volume variance that we need to work on. So now we have a plan of attack in the future that we can work on and get better at as a company, as a team. All right, this concludes the video on Check Yourself 15.2. If you have any questions, please email.